It's Brian Preston, the money guy.
Active versus passive. Where does this all come into play with active versus passive? And by the way, it used to be that active was only on the mutual fund, but we've started to see, this is why these things are so commingled. You're starting to see ETFs that now have some managed component or smart alpha.
Yep.
So they have some way component which when you see alpha or smart beta, that means a manager's not
making
just buying
some sort of
they're not
decision.
making the indice. They're not just buying the indice for what it is. They're trying to make some determination of why this is good or bad. So it's like management is coming into play. So we wanted to kind of talk about this. So when you talk about active versus passive, it is interesting when you look at SPIVA data. I mean, it's crazy. What is it, like 88% of they can't, the index beats 88% of the managers over anything greater than 5 years on the large cap side. When you start thinking about that, that means 8 to 9 of the 10 funds are going to underperform the index fund.
That's right.
You have to ask yourself, what's going on? What am I actually getting value from these active managers? So give them kind of the abound thoughts on active versus passive, Bo.
Yeah, so what we love is that where we can index, where we can buy super low cost, don't have to think about it, not beat the market, just be the market funds, we like to do that. So U.S. large cap is a great example. We think just buying the low cost, practically free index makes a lot of sense. But perhaps there are some asset classes that are a little bit more unique. You can think about even right now in a very low interest rate environment where some people think rates are going to go up and some people think rates are going to go down and some people think you ought to be on the short end and some people think you ought to be on the long end of the curve. And we have a lot of quantitative easing. We have a lot of government paper being printed. Maybe you don't want to be in like a fixed income index. Perhaps active managers could be better positioned to navigate that environment well. You could say the same sort of thing in the real estate market. Perhaps with the way that e-commerce is changing real estate, perhaps active management inside real estate makes more sense than passive management. The point that we're making is when it comes to portfolio construction design, we're not so dogmatic that it's all one or all the other. But in the places where we do choose to go active, we have a reason for doing that. And that reason usually is not because we want to beat the market. It's not because we think we have some prowess that we can do that. It's because something is taking place macroeconomically that causes us to want to shift assets in that direction.
Well, distortions. That's what it's just like when you mentioned quantitative easing.
Yep.
If you go look at index funds in the bond sector, once we continue watching the government go back to pumping so much money out there, you're going to notice it's all the indexes are going to be all governmental indexes. It's not going to have a lot of diversification. You also talk about distortions. Talk about real estate. If you know everybody's now doing Amazon, and we see all these malls sitting out there and traditional big box retailers, that's going to create some weird distortions in the retail sector. So you need to pay attention to those things. But you do need to make sure that if you are paying for an active manager, they better be performing. And they better be even overcoming the tax limitations. Because realize index funds, since they don't trade so much, they're much more tax efficient, meaning your year-end distributions are substantially lower. You just want to make sure that you're doing a lot of research, a lot of due diligence, because a lot of times, whether you're talking about international, whether you're talking about domestically, the index funds do incredibly well, and they take a lot of the guesswork. They lower fees. There's not that headwind. It's a good thing to look at the index funds in a lot of ways if you can go the cheaper route.
So I want to repeat what I just heard you say, Brian. When it comes to like active and passive, it's not either or. It's potentially both and, depending on the circumstance. Wouldn't you say the same thing could be said for mutual funds versus ETFs? It's not either or, it's most likely a both and, depending on your individual circumstance and what you're trying to accomplish.
And we've talked about, I love index target retirement funds for those under $500,000 because it lets you focus on the savings and lets them focus on the asset allocation because they go from aggressive to more conservative as you go through the years. But it's like that with the individual investors. You are going to reach a level of success after $500,000. You'll need the additional attention. You'll need to go ahead and look at tax loss harvesting, tax location, all these things that come into play that it's just better to have a more custom route than just buying the all-in-one target retirement fund.
And so I think, Brian, that's a beautiful segue because as we were sitting down thinking about, obviously the listeners are going to want to know, well, how do I decide, when does a mutual fund make sense? When does an ETF make sense? Well, we said, let's think about some of the unique financial planning opportunities that we do for clients, sort of on a regular basis, or things we look at year to year, and kind of share some of those so that you guys can use that as you think about how you build and construct your portfolio.
So I want to jump right into these because
Sure.
I think the first one, when I'm thinking about unique planning opportunities, capital gains should come into play because when you talk about what is the tax impact of what's going on here, capital gains, like if we have somebody who's brand new client, they come to us in fourth quarter, if you go buy a just portfolio full of mutual funds, you have to be careful because there
Absolutely.
might be some embedded capital gains that are going to be distributed out that you don't want your client signing up, going and investing in a portfolio, and then getting a big tax bill at the end of the year when they've only been participating for a short period of time.
This is a common misnomer that I hear all the time. Someone will say, hey, Bo, I saw this fund, and if I hold this fund on December 5th, they're going to issue a 14% capital gain distribution. Doesn't that mean I'm going to get a 14% rate of return if I own it on that day? No. All you get is the tax bill. It's actually a net neutral zero event. They decrease the value of your holding, and you just get to pay the taxes on it. So if you can avoid those large distributions of mutual funds at the end of the year, it likely makes sense to do so.
So just to make sure y'all heard him, they adjust the price that mutual funds trade at for those distributions. So don't get excited thinking, hey, I'm going to go buy this fund the day before they record the investors of record, and then I'm going to make 14% just because I bought in. No, they'll lower the price of your investments. Yes, you will still. That's why it ends up being a neutral event, but you are going to pay the taxes on that income. So pay attention to that. But look, it cuts the other way. We just came through a bear market. There's a chance if you went on Morningstar and looked at values as of 3/31, there might be a group of mutual funds out there that are trading at a discount, meaning that if you look at are there embedded losses that are within their portfolios, that means you could buy into a mutual fund and maybe it could make 10 to 15% before it gets back to break even, where you're going to have 10 to 15% of gains before distributions might even come into play.
They've actually done, this isn't really what they did, but they kind of did some loss harvesting for you. We did a ton of this in 2009 at the beginning of the year. We'd actually go screen our mutual funds, and if there was a 30 or 40% embedded loss, and we felt like that fund was positioned well to perform well moving forward, we'd absolutely go grab that. Then we kind of had a tax-free ride for that first 20 or 30%.
That planning opportunity only works coming out of down markets. Now realize, markets typically make money 8 out of 10 years. So more than likely you have an embedded gain in your mutual fund, not an embedded loss.
That's right.
But there are some unique times, twice every decade usually, we just came out of one, that there might be some embedded losses. And in those situations, a mutual fund with an embedded loss is better than an ETF because every dollar you make from the day you invest with the ETF, you're going to pay taxes as it gains. If you have an embedded loss on the mutual fund, you might have a head start before you have to start paying the tax man. So pay attention to that. And then, those are some of the big things that are going on. But let's talk about the intraday pricing.
Yeah, so one of the things that is a benefit is you have some hands-on control over the price that you trade, right?
Sure.
So, again, we just came through this COVID-19 thing, and there were days where the market would open up down 6 or 7%, and the client would call me like, hey, the market's down, let's buy. Well, if we actually behaved in that way, if we put in a mutual fund trade, we wouldn't actually be capitalizing on that because a mutual fund doesn't trade until the end of the day. If you wanted to capitalize on the market being down in the morning, you'd have to buy an ETF to do that. Well, intraday pricing allows you to have a little more control over the timing of the trades that you're placing.
Now, I'm going to sound a little bit, maybe it's because I'm getting older, I'm more like Jack Bogle, is I think that those price fluctuations throughout the day tend to push you more towards the speculative side of investing versus the fundamental side. And this is the part, I alluded to it earlier. We went on a 40-minute, I had 2 slides built into this presentation explaining the distortions of mid to late March with bonds, bond ETFs specifically. The team made me throw out these slides because they were worried you guys were going to go to sleep. So I'm just going to try to do a really good job of summarizing this. March 18th, 19th, 20th. You probably could throw in the 20th. There was a lot of crazy things going on in the equity marketplace. that was bleeding over into the bond ETF marketplace. So what we saw was if you were buying a bond ETF of like the AGG, the price fluctuation throughout the day could have been as high as 4 to 4.5%.
In one single day of trading, the price moved that much on a bond ETF.
And then think about day two, because put 2 days together, another 4 to 5% fluctuation. If you were the worst investor or unluckiest investor, you potentially could have a 10% fluctuation on your risk-off bond fund when really the bond fund traded in less than a 1% trading band if you were buying the mutual fund.
So inherently, if you are trading ETFs, because of those price distortions, even taking away from just generally the asset class you're investing in, you are naturally adding risk to your portfolio just because of how much those prices can fluctuate intraday.
Now, fortunately, this is the second slide that y'all made me take away. The lion's share of the time, 90% of the time, ETFs trade within the ending value of the NAV value of their brethren that are mutual funds. So it's not this is only in unique, distorted times. I'm just saying that if you're an investor and you're looking at your investments from what's risk on, like equities, risk off, like cash and bonds or fixed income, you might need to think about that extra level of risk or volatility, because you might be counting on this money to be super safe, but then you find out it's got 4 to 5% price fluctuations just because of the intraday pricing. That's just something you ought to take into account, because it is exactly what Bo said. It pushes it further out on the risk spectrum than what you might have been anticipating when you bought the product.
That's exactly right.
Was that better than the 2 slides?
That was so much better than the 2 slides.
Reby, do you agree?
That was so much better.
How did we talk about that for 40 minutes before poor Daniel, I had him changing slides. We'll keep it going. But that probably did sound better than the 2 slides I had.
The next planning opportunity. Here's the planning opportunity from that. Just because you can trade intraday, you probably shouldn't do a lot of intraday trades when there's wild volatility, especially inside of ETFs, because potentially what you're trading, you're getting more than you bargained for. I just put a nice little bow on that. All right, so let's talk about the third one, loss harvesting.
And this isn't necessarily, now tell me, you might disagree with me. I don't think this is a ETFs versus a mutual fund. I think this is just a tactic that you can use, but loss harvesting is something, let me say, first of all, definition.
Okay.
Loss harvesting, all that means is within your taxable accounts, not your retirement accounts, but your taxable accounts, if you have a loss, you can lock it in and turn that loss to where it becomes a paper loss that you actually take a tax deduction for or offset gains in the future. Now here's where I think why we put this in here. ETFs get some special treatment in the fact that it's much easier. Like you could sell the SPY and then go buy the total bond, another ETF or total bond. I mean, total stock market index fund. And you essentially, even though you sold the S&P 500 ETF, it's enough difference there that you could probably lock in the loss.
Yeah, one of the strategies that we were able to employ in the first quarter of this year is that the market fell so rapidly, so quickly. Normally we're able to loss harvest, I don't know, maybe one time a year in down years. Well, what it allowed us to do is we could have an index-esque fund and the market could drop and we could loss harvest and sell that fund and go buy a materially different fund but inside the same asset class. Well, then the market would fall further inside of 30 days. So we couldn't go buy the original fund. We had to have a stable. What ETFs have allowed us to do is build a stable of similar but materially different ETFs that we can loss harvest across. With mutual funds, at least in our experience, it's been a harder thing to do. ETFs might allow you to do that. Now, here's what you really want to do. Have a stable of both, and then you can kind of control what exposure you're doing. That's how you end up having a very tax-efficient portfolio long term.
Now, a lot of people, because I've had a few people question us when we've done episodes on loss harvesting, they'll be like, but don't you end up in the same place? I mean, if you're selling $1,000 turns into $5, now look, I'm using super low. Maybe I should use a bigger number. Let's do $100,000 goes down to $50,000, but then back up to $100,000. If you did absolutely nothing, your $100,000 still is $100,000, went down, went up. The difference with a loss harvest is you go down to 50, you lock in the $50,000 loss, you buy another equity type investment that's different enough that you can take the paper loss. It goes back up to 100. Yes, now you have an embedded gain of 50,000, but you have a paper loss of 50,000. You are in the same place. Here's the difference. You're holding for years. So when you file your taxes in April, you're going to be able to actually turn a portion of that loss into a tax deduction that will lower your taxes.
Absolutely.
The guy who did absolutely nothing, not going to be able to turn that into it. The other thing is, if you're charitably minded, if you sold low and now you reinvested and now you've got this essentially 100% gain on the purchase when you bought when it was low, if you gift that to a charity or donate it to a charitable gift fund, you get the max deduction for the market value. It's just a great planning opportunity. That's why we're talking about unique planning things you can do that's a little more sophisticated, but definitely takes advantage of it. And ETFs do give you some additional tools there. Let's pivot now to, because I don't want to just pick on my mutual fund friends. We need to say mutual funds have a place too. How about automatic dollar cost averaging? Yeah,
this is the one. We've already kind of alluded to this. If you are someone who wants to set up an automatic dollar cost averaging plan where every month I want to have $100, $250, $500, fill in the blank, and you want to just have that going, you don't think about it, you don't look at it, you just have it automatically purchase. Mutual funds are going to be the best way to do that. It's much more difficult to do that with ETFs. In my experience, I've had folks say, no, I only want to invest in ETFs. I'll just set a teaser that every month on the 10th, I'll just go in and buy $100 that ETF. Yeah, that's easy to say until the day that you go in to buy, maybe the market's down really, really bad. And you're like, oh, I don't know about that, when you should be excited. Or worse, what if the market's up a lot that day? By using mutual funds, you remove some of that emotion where you don't have to think about it. You don't have to figure out when to buy, when not to buy. You just set it and let it automatically start working. That's one of the reasons we love. Whenever we set up automatic DCA plans, we do it in mutual funds, so you don't even have to worry about it.
So we got kind of fancy with some of our retirement plans, put some ETFs in there. Then a lot of the 401k providers came back and said,
we're not doing that.
We're not doing this. Mutual funds are so much easier because of all the things we just talked about with automatic, systematic savings plans. Mutual funds are just easier.
That's right.
So that's why, think about that when we were talking about the pros and cons, but it is one of those things that I think definitely leans more towards a mutual fund. All these things, I know we started this talking about the conflict. We had even Jack Bogle talking about wolves in sheep's clothing. I wanted to make sure I got that right. Wolf in sheep's clothing.
Wolf in sheep's clothing.
That's the way he described ETFs, because they were kind of getting into the territory of his sacred index funds and index investing. But I think as we've shared in today's show, there's actually a place for both. You just need to know what each one does well, what each one has limitations in, and then make sure you're just marrying the perfect combination for what your financial situation needs.
That's exactly right. We think they're just two different tools in your tool belt that can make sense in different situations.
When you say tool belt, it makes me think that I could have worn my Batman shirt and you could have worn the Robin shirt again, and it could have been we could have done Batman and the Boy Wonder.
You know what? I'll at least take like Tim the Toolman Taylor and Al Borland. I would even take that one. Hey, speaking of tools,
greatest thing I've ever done is make us do the Batman and Robin show.
Yeah, I love it
because it just is the joke that keeps on giving.
Hey, if you haven't seen that show, you should go check out Money Guy Superhero Show because that was fun. But speaking of tools in your tool belt, in your financial tool belt, one of the great tools that you can use is the Money Guy team and the resources we make available to you guys. If you've not gone out to our website, moneyguy.com/resources, out there we have worksheets, templates, PDFs. It is all available for you to use. We just had a meeting this past week adding new deliverables. They're in process. We are in the Bat Cave or the Robin Cave, putting them together, getting them ready for you guys. So if you've not gone to check out the resource page, make sure that you do that. Give us your email address. That's the only way you're going to know when we put new stuff out there for you.
And guys, make sure you subscribe. Have the awesome, audacious goal of 100,000 by year end. I think Bo's starting to question it. I still have faith that you guys are going to get us to 100,000. So go subscribe on YouTube. Also ring the bell. And then don't forget, Bo just talked about the resource page. We need your email address. So when you go to the moneyguy.com website, give us your email address so we know who you are, so you can join the Money Guy family, and you will not regret the decision. We've been doing this since 2006. Plan on doing it for decades longer. lots of resources. The abundance cycle explained as you come here, there's no catch. You learn from all the free advice, apply it to yourself. You will reach a level of success that you get so scared that, hey, this thing is so big, I don't want to screw it up. It's so big that I need to make sure I'm maximizing all those unique custom opportunities. This is when I need to have a co-pilot. You're going to remember the guys that got you there, and that's the Abound Wealth crew. So that's the abundance cycle explained. So enjoy the free stuff, and thank you for supporting us. This is the Money Guy team, and we're out.